Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks again for joining us for our latest market update and outlook video for the month of September. First of all, I just want to say my heart goes out to all the people that were affected by Hurricane Ian. We were affected over here a little bit. We lost power for a few days, but it wasn't too bad, so thankfully we fared okay, and I hope you did too. But the month of September has been pretty rough. I'm going to get into what's going on, where's this volatility coming from, and I also want to highlight at the end in the outlook a couple catalysts that can turn things around, that can maybe help us finish in a little brighter note at the end of the year or at least early next year. So I hope you guys enjoy it and find this useful. Thank you. Alright, let's get started with the asset class returns. As you can see here, for the month of September, it was a pretty lousy month. We have the S&P 500 down a little over 9%, as well as small caps. Real estate down 13%. Real estate can be a little bit more interest rate sensitive, and we had some movements in rates up, which we'll talk a little bit more about in the market update. International was down as well, 10% for developed, 10% for emerging markets. And as you can see across the board, the markets are down over 20% for the year. So we're basically in a bear market in basically all categories. So not any places to hide really there in the international or in the stock market front. On the fixed income side, the market here has not been friendly. We haven't had any place to hide here either. The high quality bonds were down over 3.5%. High yield bonds down about 4%. So negative 13 and 14 for the years. This is pretty unprecedented to see such a big drop in bonds when stocks go down this much. And we'll talk a little bit more about those dynamics in the update, but not good to see. Commodities has been the one bright spot. Again, up 13% for the year, which is nice, so that's been helping. Although you see commodities take a little hit also for the month of September. And I think what's happening here is the development of more recession concerns rather than inflation concerns, although inflation's still around and still haunting the Fed, which is why they're raising rates, but it's just not down enough. So we'll talk more about that in the outlook. So thanks. Alright, so the first topic in our market update is the Fed ups the ante. So you guys are probably starting to get tired of me talking about the Fed. Well, it's kind of a big deal. The Fed has been the major catalyst to what's been going on in the market. You could argue for the last 10 plus years, but really over the last couple of years, it's been even greater. And so what happened recently, we had their September meeting. They raised rates 0.75, which is 75 basis points. And it was basically what everybody expected, so that wasn't a big surprise. The market didn't really react to that, but it was what Jay Powell said afterwards during the debrief, where they talk about what they're answering questions and what they may do down the road. And they're talking really tough. They want to fight inflation. That's why they keep raising interest rates. Raising interest rates slows down demand and hopefully also slows down inflation, at least demand inflation. And so the big shock was the guidance that they gave for the rest of the year and for 2023. And so the expectations was maybe another 50 to 75 basis points before the end of the year. And now it's looking like it's going to be more like another 100 or 125. So they're talking really tough. Now, I don't know if they'll actually do that, but you got to take them for their word, because they probably feel like they're a little bit behind because they started a little bit later than they probably should have, and now they are trying to make up for it. They might be making a mistake. We shall see. And this is something I closely monitor. But they're doing the best they can to fight inflation, which we'll talk about here next. All right, the second topic here is about inflation. Again, it seems like it's all inflation and the Fed over the last 6 to 9 months. But this is the crux of what is moving the markets here. And so the last inflation print that came out in September, the inflation number, which is measured by the CPI, Consumer Price Index, was down to 8.3. So that's a good sign. It actually did come down a little bit. Unfortunately, it didn't come down very much because it was at 8.5 and we were at 9 in July. So it's coming down, but it's coming down slowly. And the reason it's coming down stubbornly slowly is because of the headline, or the core, I should say, CPI. And this is where you get more of the shelter costs, like housing, and rental, wages, and food. Food has actually still been going up a little bit. So until those numbers can really start to come down, we won't see this headline number start to really make noticeable changes. And unfortunately, the only way the Fed can really control and try to rein this in is by slowing down the economy. That's why they keep raising rates. So this is all interconnected. As the inflation number goes down, that allows the Fed to raise rates less, which then allows the market to have a little bit more breathing room and maybe start to stabilize. But until this number really starts to come down in a pattern that is a little bit more long-term and substantial, you're going to see the Fed continue to pump the brakes on the economy. All right, the last item that I wanted to highlight for the market update is how strong the dollar has been. So you can see here on this chart that the dollar is at about 112, which is the highest that it's been since like the year 2000. We're talking multi-decade highs. And what happens is when the Fed raises interest rates, again, because they're concerned about inflation, they're trying to slow things down, right? So as they raise interest rates, the dollar gets stronger because we're raising it faster than everybody else. And so relatively speaking, the dollar's going up more than the euro and the yen and the pound and all these other currencies. So the reason I bring this up is it has been helping us a little bit from inflation being as bad as it could be, but it's actually making inflation even worse in other countries. And my fear is that the Fed continues on this really aggressive path, they could start to create a global crisis outside of the U.S. The U.S., it wouldn't be as bad, of course, but in Europe and Asia, it could be a lot worse. So I think the Fed is going to have to start to take that into consideration. And so we'll talk a little bit more about that in the outlook and how they might pause and pivot and different things that might happen. But I think this could be one of the things that they're going to be taking a look at because the dollar is really strong. All right, let's kick off the market outlook with the leading economic indicators. So when you look at this chart here, you can see the blue line is the leading indicators. Now remember, the leading indicators are the metrics that measure the economy. They're trying to do a forecasting. The coincident indicators show more of what's going on right now. So the blue line has done actually a pretty good job as they start to roll over right here. You can see that the gray bar, which is a recession, shortly comes after that. So as you can see here, the blue line is rolling over again. So there's a pretty good chance that a recession is coming. So the coincident indicators don't do that as much. And so this is why this and many other indicators that I look at are starting to show that the recession signs are growing higher. The probability where I was close to 50-50 a few months back probably more in the 60-70% range for a recession. So the Fed is getting what they want here. They're slowing things down. The trick is, can they slow things down so that we control inflation without going into a severe recession? And I do hope, and I do think that's still a possibility. So the mild recession is still a higher probability than a severe recession, but it does look like we're probably going into a recession, and that's the reality of the moment. Alright, so far this video has been pretty gloomy, and I'm just trying to be real and give you the data that's out there. But you guys, if you know me, you know that I'm a pretty optimistic person. So I'd like to end the video with two catalysts that I see that could be nice positive catalysts for the end of the year. One of them is the midterm elections that are coming up here in November, really about a month away. And so historically what you see with these midterm elections, which by the way, if you want to get a little bit more information on this, I did a video on this a couple weeks ago. That's on the YouTube channel, so go check it out. But in a gist, the second quarter and the third quarter before the elections tend to be kind of depressed quarters, and a lot of it is because there's a lot of uncertainty of what's going on. And then the fourth quarter and the first quarter following the midterm elections tend to be much better quarters historically speaking. I mean, there is a really certain pattern there. It's really interesting to see. And I think, again, it's because now there's more certainty of what's going on. Now, some of my political friends will also make that argument, you know, that there's certain things that are changing that could be good. And now, that's hard to say because we don't know what the outcomes of the elections will be. And, of course, all these points are debatable. But if you do believe that there could be some positive catalysts because of the political changes, that could be an additional catalyst to the positivity here that I'm talking about. Now, the second catalyst is the potential that we have reached peak inflation. Okay, and I think this is probably the strongest argument that I have for things that turn around potentially here at the end of the year or at least early next year. Because what you could see here is, and this is an example of different years when inflation has peaked, what has happened the following 12 months. Now you can see that pretty much in all cases the market is positive in the next 12 months. Now there are a couple that they were negative. That was the Great Depression and the Great Financial Crisis, and there were a couple flat ones. But most of them are positive. In fact, the average 12 months after peak inflation, the market has averaged about 11.5%. All right, so got this chart from BlackRock. So I thought this was a really strong argument. Now, the big question is, are we at peak inflation? Now, it does appear that we are at peak inflation. It looks like it probably happened in June when we got that July CPI print of 9.1%. Now, things can happen and that can change, but I do feel pretty strongly that we're probably moving down in inflation. Unfortunately, not super fast, so that could delay things being as good as some of these really high positive years. But I think it is definitely coming down enough that it will provide a tailwind for the market again over the next 12 months. So when you're looking at the markets, if you can look past just the next quarter, the next few months, and start thinking a little bit more long term, I think the patient investor here can really start to get rewarded by hanging in there and maybe even taking advantage of the fact that we're probably at peak inflation, because the returns to follow could be pretty strong. Alright, so what are the Heartwood implications for your portfolio based on all this information? Well, if the market is slowing down and we're going into some sort of recession, hopefully more of a mild type, we're definitely going to want to start to reduce a little bit of the commodity exposure. I'm being very strategic here in reducing that down, because recently you probably saw in the news how OPEC is lowering production, which made oil prices go up, which is making commodity prices go up. But I think that will probably be more of a short-term phenomenon that will fade as the recession continues to get a little bit stronger. And so we'll be doing some of that, and we'll be moving it into more high-quality bonds. The bonds have just been really annihilated. The biggest hits that I've ever seen in the bond market. So these are opportunities in the bond market that haven't been seen in 30, 40 years, and the yields are actually starting to get quite attractive. And bonds tend to do pretty well when there is a recession. So I'll be adding to the high quality bonds from some of the reductions in the commodities, and also reducing the international stock. Again, I talked about this last month. I'm doing a little bit more even now because it looks more and more firm that Europe and even parts of Asia are going through a slowdown that's going to create a recession that's going to probably be even worse than what we're seeing here in the US. So basically getting a little bit more conservative overall and taking advantage of the higher yields in the bond market, and just hunkering down until we get some sort of catalyst, maybe one of those two that I brought up, so we can have some dry powder ready to go as things hopefully turn around here towards the end of the year or early next year. Thanks everybody for watching. I hope the videos were helpful. Again, if you have any questions, please feel free to reach out, give me a call. Happy to help. Thank you.